So easy, so easy. So easy, so easy. So easy, so easy. So easy, so easy.
Good afternoon, everybody, and welcome to everybody joining us today. It is my pleasure to be hosting you. My name is Bongani, and I'm part of the EasyEquities Wealth Department. Today's topic of discussion will be about ETFs and unit trusts. More specifically, their differences, any similarities, and a few other interesting things about them. We have partnered up with CoreShares for a two-part series, today being the first. And if you don't already know about CoreShares, let me fill you in a little bit. They're one of Africa's leading passive investment management businesses. They specialize in index tracking solutions across ETFs, unit trusts, and other products. Now, my guest today needs no introduction. Michelle Noth joined CoreShares in about 2019, if I'm not mistaken. She's responsible for sales and marketing across all client categories. She also oversees a distribution network for the CoreShares ETFs and their unit trust ranges. Prior to this, she spent about 13 years working in the financial services sector in London, where she specialized in ETFs and passive investment solutions. I think it's safe to say we called in the big guns today. Just a quick one for anybody. If you do have any questions, please be sure to leave them in the Q&A box and not the chat box. So, Michelle, without any further ado, the stage is yours.
Thank you so much, Bongani. And thank you to EasyEquities for inviting CoreShares here today. I think it's really wonderful that there's so many fantastic financial education initiatives at the moment, and these sort of webinar formats just makes it so easy for everybody to, inform themselves. So yeah, we're very pleased to be here. And as Bongani said, please feel free to put any questions in the Q&A tool. We're going to have plenty of time at the end for that. My presentation will last around 30 minutes, and then we'll really have plenty of time to get to all your questions. So let me see. Bongani, is my screen sharing?
100%.
Okay, excellent. So let's just jump right in. Unit trusts and ETFs. What is the difference between these two wrappers? So let's start with a unit trust. So really getting back to basics, it's a collective investment scheme. So it's a pooled investment, and it's just a wrapper. So inside that investment, there can be active strategies, passive strategies, a whole wide range of different kind of asset classes. Unit trusts are regulated by the FSCA, so really nice secure investment. And this fund, you can think of it like a shopping basket. So there's a whole lot of different products in there. So think of it as a basket of shares. So by buying one single fund, investors are getting exposed to a whole range of companies. And unit trusts are bought and sold through private channels, so either on a platform or directly versus the manco, which is the asset manager. So, when you're buying or selling a unit trust through EasyEquities, for example, they are then trading directly with the asset manager on the other side, on your behalf. So what are the benefits of this, pooled investment scheme? So obviously, the first thing is this huge range in South Africa. So across all asset classes, multi-asset, combining the asset classes for you, flexible mandates, etc. There's over 1,000 unit trusts in South Africa. This is a simple starting point for investors. So it's easy to get started investing in unit trusts. On the fact sheets, there's a lot of information. So there's, good transparency there. You'll find out what the mandate of the fund is, what is it holding, what is its track record, what are the fees involved. They're also typically fairly liquid, so you can enter or exit your investment on any business day. There's one price per day, so no matter what time of day you give your instruction, you're going to get that one price a day when the unit trust trades. And it settles T+1, so if you sell it today, you're going to get your money back tomorrow. So that's what T is, the day of trade, +1. So sell today, get your money back tomorrow. Very important benefit here, a low initial investment amount. So that's really the benefit of a pooled investment like a unit trust fund. So this is a low barrier to entry. So, you know, even if you want to have 500 Rand a month or something like that going into your investment, it just goes into this big pool of money, and they can still go and buy that whole big basket of securities. And you can invest in a Rand amount. So if your instruction says buy 500 Rands worth, for example, you'll get exactly 500 Rands worth of the investment. It goes without saying that there's a huge diversification benefit. So diversification basically means you don't want to have all your eggs in one basket. So by having lots of different shares, lots of different companies in this one investment, you're diversifying away that risk of having too much exposure to one company. So, you know, the problem if you get another Steinhoff or something like that, you don't want to have any single company that's a large portion of your investment. So that's really the benefit. If you've got lots and lots of companies in there, you diversify the risk of having, you know, one company that might have a problem with the management team, or, you know, something like that. So you minimize that risk by having a big broad basket of lots of different companies in there. And finally, you know, it's regulated and secure. So we spoke about that it's regulated. Also, funds are separate legal entities. Your money is ring-fenced. There's a trustee that's overseeing that. And of course, you've got access to a professional fund management team that is managing your investments. So moving on from unit trusts, let's go and look at one of the other common fund wrappers, and that is exchange traded fund, or an ETF. And really, the difference, I just want you to, you know, get comfortable thinking of these as just different wrappers, and they operate in different operating environments. But that's really, you know, that's really as far as the difference goes. It's the operating environment. So an ETF is also a collective investment scheme. They typically track an index. So all of the ETFs in South Africa at the moment are passive, so they're tracking an index. But globally, the definition is much broader, and there are starting to be a whole lot of active funds that are available in this wrapper. So again, it's just a wrapper. You can put, you know, a whole lot of different type of things inside the wrapper. So ETFs are both regulated by the FSCA and the JSE. So because it's part fund and part share, in the sense that it trades and settles like a share on the exchange, it has got oversight by both the FSCA and the JSE. And so, you know, again, by investing in this one ETF, you're getting access to a whole basket of shares, so lots of different companies. But here's the main difference. They're bought and sold on a public stock exchange, just like shares. So when you are investing through, you know, your account at EasyEquities then can trade ETFs by going to the exchange, rather than, like in the case of a unit trust, having to go and face all the individual asset managers to trade their unit trust. So that's really the big difference between an ETF and a unit trust. And, you know, by the same token, ETFs can be traded through any stockbroker or any share trading account. So any sort of account that allows you to trade shares on the JSE would also be, you'd also be able to trade ETFs. So they're very simple and accessible in that sense. So the benefits of ETFs really are, you know, all the same as the benefits that you would be getting from your unit trust. But in addition, there's additional transparency benefits with ETFs. So actually the holdings have to be fully disclosed on a day-to-day basis. The trading price is known throughout the day, and all the costs are very transparent. Very liquid products. So ETFs are open-ended funds, and they're trading on the exchange. But the fact that they're open-ended and trading on the exchange gives rise to two pools of liquidity. So the secondary market means the existing units of ETF that are being traded on the exchange, but there's an additional pool of liquidity underlying that, which is the primary market, or another way to think of it is the liquidity in the basket of shares. So for example, all the shares that are in the index are trading on the exchange as single shares, and then the ETF is trading as a single share. So the market maker, if they've got a big order to buy or sell, if there's not enough units of the existing ETF trading on the exchange for what they need, they can actually go and trade in the underlying shares. So for example, if you needed to sell quickly and there wasn't enough buyers on the exchange, what the market maker could do can sort of unwrap your ETF units and get that basket of shares and then go and sell those underlying shares. And that's really the benefit of the liquidity of the primary market. Another difference here between unit trusts is that ETFs typically settle T+3. So if you trade today, for example, if you sold today, you get your money back in 3 days' time. And that is how all shares trade on the JSE with this T+3 settlement. However, I think, Bongani, maybe you can jump in here or we can discuss it at the end, but I think EasyEquities has a facility where you can actually have your ETF settle a bit quicker, but that's something specific to EasyEquities that they have created for their clients.
Yeah, that's definitely correct.
Okay. Yeah, so I think, and then going just through the other benefits of the ETF. So again, you have that wonderful diversification benefit. So, one line on your investment, one investment, but you've got this whole group of securities behind, which can, be exposure to lots of companies in one particular country or lots of companies in one particular sector, for example. So there's lots of different ways to group the assets, and there's really a broad range of asset classes and themes and geographies. That being said, the ETF industry is still developing in South Africa. So while I mentioned earlier that we've got over 1,000 unit trusts in our market, we've got sort of over 100 ETFs. So still growing, lots of new products coming to market. But again, that's really the benefit that having an EasyEquities account offers, is that you can trade both ETFs and unit trusts in one place. So they make it very simple for you, even though the operating environment on the back end is different for these two different fund wrappers. The experience for you as the investor trading through the EasyEquities portal, it will make it very easy and similar. And again, these products are very flexible. You can buy or sell them at any time that the market is open. So on any business day or any market day, there's continuous pricing throughout the day. So it's actually the responsibility of the ETF issuer. So us as core shares, with our range of ETFs, we have to have an appointed market maker that's putting bids and offers on the exchange all day long. So that if one of our clients wants to buy or sell our core shares ETFs, there's a market maker there to facilitate that trade for you. And so these products are appropriate for all types of investors, and they're very easy and accessible. So as I mentioned earlier, anyone with a share trading account can access ETFs. And one of the huge benefits that we hear about, this is probably the one you hear about the most, is how cheap these products are. Very cost-effective route to diversified market exposure. So with that, I think it is a good time to unpack some of the fees, because one of the things that in financial markets, we've had so many regulations over the years, which is great for investors, and there's a lot of disclosure and a lot of transparency. But I think sometimes it can become a bit like alphabet soup with all these different charges that are being disclosed. So we really get lots of questions about fees, and if you feel a bit boggled by all these different abbreviations, please don't feel alone. This is something that we get asked a lot. So that's why I decided to put in a slide on this. So what are the fees of these two different types of fund structures, unit trusts and ETFs? So I'm going to build up from the bottom so that it's so that you can sort of visualize how the fee structure works. So the starting bottom smallest fee is the management fee. So that's what we as the asset manager are charging for our service and expertise in managing the fund. So the management fee is typically the smallest or sort of lowest amount, or the starting building block of how these fees build up into the final number. So then on top of that fee, you get sort of some running costs that are charged to the fund. So as I said earlier, funds are separate legal entities with trustees and regulation and oversight. And sort of all of that generates some costs, obviously, in managing the separate legal entity. And those costs are in the form of, bank charges to the fund, audit fees to the fund, custody, trustee fees, etc. So when you start with a management fee and you add on those sort of running costs, then you get to this, this fee that you probably hear quite often called the total expense ratio, or the TER. And that is often one of the fees that are used to compare funds across the market, because it's quite consistent, the definition. So all fund managers that are disclosing a TER would have had to calculate it in this way. It's important when you're comparing fund fees that, for example, in the one fund, if they've shown you a TER, that you're comparing that to a TER in another fund, not that you're comparing a TER in one fund with a management fee on another fund. So that's why it is quite important to sort of make sure you're comparing the same fee. And if you see a TER and you see a management fee, just to reiterate, you don't have to add them together. Inside the TER is the management fee. It's included in there. So you build up the management fee plus those running costs like audit fees and those like bits and pieces that get charged to the fund gets you to a TER. And then finally, building up to the TIC, which is the total investment charge, is you take the TER and you build on top of that any of the transaction costs that are going on inside that fund. So, for example, in the case of an active manager, if the portfolio manager has decided to, I don't know, sell Cecil and buy Woolworths or change the allocations around, they're going to be selling some shares and buying some shares. There's going to be some trading costs and commissions being generated. Those costs go into the fund. The same for an indexed fund. So if the index rebalances on a quarterly basis and some shares drop out, some go in, some of the shares reweight, there's going to be some trading costs related to that. So those are all the type of transaction costs that get added in. So when you go back to number 2, the TER, you add on top of those transaction costs. There's also something called STT in our market, which is sort of stamp tax for trading shares, which is another tax going to SARS. And then you get this total number, which is the TIC. And that's really the number which is telling you how much is going to get taken off your performance or your returns. What are you going to be left with after that is going to be your returns. This number 4 is something to distinguish between ETFs and unit trusts. So again, just going back to the fact that they operate in different ways. If you or I invest, if we as new investors come and invest some money into a unit trust, the trading costs of putting that money to work. So the fund manager is taking our cash and they're going to go and buy the underlying shares. In the case of a unit trust, those trading costs, those transaction costs get charged into the fund. In the case of ETFs, those trading costs are explicit. So you or I, the end investor, when we go and buy or sell an investment, we pay the cost of that in the form of bid offer spreads and commissions. So that is explicit. So the way that you see that in the different funds, so for example, we've got some exposures where we run it as both a unit trust and an ETF. So what you'll find is that the ETF always has a lower TIC because you as the investor have actually been paying some of those costs when you buy or sell the ETF to get into the ETF. So it's not included into the ETF's charges, whereas with the unit trust it is. So everybody else buying or selling, their costs are getting averaged across all the fund holders. And that's, again, just a little distinction. I think this is really the closing point that I want to leave with you today. And I know it's been very hot in Cape Town. So for those of you like me who are based in Cape Town, who had a very hot weekend, eating way too much ice cream, this seemed like an appropriate analogy to use today. The difference between a unit trust and an ETF is really just how would you like your investment served? So just think of it as the wrapper, the thing that's carrying your investment. So it's more or less like the decision to have your ice cream in a cone or a bowl. If you have your ice cream in a cone or a bowl, there's some operational differences, like with a bowl, you're going to need a spoon to eat it. With the cone, you're just going to lick it. But ultimately, the main decision, the most important decision with you ordering your ice cream is actually what flavor you're going to have. So what is going to be in that cone or bowl, what flavor? And that is really what I'd like to leave with you today. So regardless of whether your fund wrapper is a unit trust or an ETF, the most important decision for you as the investor is actually what exposure, what are you going to invest in? So with that, I'm going to just touch on, so I'm sure there are going to be some questions on this, so please feel free to keep popping questions in the Q&A tool and we'll get to them at the end. But I'm going to touch on the most important part, which is where do you start as the investor? And, what you'll find, a lot of the academics will tell you is that the most important decision with any investment portfolio is the asset class decision. That's the decision between equity, bonds, offshore equity, local equity, cash, etc. And that macro decision or that asset class decision is very hard. And Chris Rule, who's our head of product at CoreShares, has created this lovely, I call it the disco chart. And he's going to be presenting the next webinar next week. But let me just sort of talk you through this. So let's look at SA property, which is the bright orange box, so in the key on the left, the top one. And we can see here, looking at the history of how the different asset classes perform from going back as far as 2004 to 2021, so 15 years of history there. SA property has really been the most volatile, I guess it's either one of the top performers or one of the bottom performers most of the time. And then sort of, the first, top or second top performer. And then 4 of these years out of the 15, it's sort of bumbled along in the middle. But for the most part, it's either shooting the lights out or disappointing us. And I think for most of us that have been, watching the markets and investing over the course of 2018, 19, and 20, will remember how disappointing SA property was. And a lot of investors didn't want to touch it, didn't want to have any of it in their portfolio. And then what does it do in 2021? It shoots the lights out again and surprises us all, returning 37%. So really the point of and again, looking at SA equity, which is the sort of turquoise, light blue color, again, that's sort of either one of the top 3 performers or a bottom performer, very volatile. And then something like SA cash, which is very low risk. That's sort of either bumbling along in the middle or sort of offering very little performance at all. So the purpose of this chart is to A, tell you that the asset allocation decision is very important, but B, that it is very, very difficult to do. So should we all give up and just put our money in the mattress? Absolutely not. Let's just go back to first principles. So as the investor, the most important thing is to define your goal. Are you saving for retirement, or are you saving for a family holiday in 1 year's time? Are you saving for the kids' college education? So defining the goal is the most important starting point because it informs the next most important decision, which is the time horizon. The investment mix for a long-term investment versus a short-term investment is very, very different. And finally, what is your risk appetite? Are you willing and able to endure the bumpy ride to reap the long-term rewards? Or are you somebody who's going to look at your investment statement every week and totally panic and feel nauseous if it is down, 5-10%, during some rough periods and want to sell everything? Because that is very important to decide. And that's where, financial advisors are really very, very good at helping investors to identify their goals and identify their, investment personality, if you want to think about it that way, your risk appetite. How willing and able are you to endure, the bumpy ride for long-term rewards? And this is just an example of what I mean by sort of long term. So if we look at, again, SA equity and SA property, the gray and blue bubbles on the top right of the chart, these are the riskiest. So they're the bumpiest, offering the bumpiest ride. So along the bottom axis, you can see risk is high, but they also offer the highest return. And again, I'd say that's, over the long term. So, and then you can see on the bottom left here, world cash in orange. That's a low risk investment, low risk and low return. So fortunately, what we can see here is that as the risk increases, the return increases. And that is, again, why the time horizon is so important. So how does this interact with the time horizons? So looking again, the bubbles are in the same place. So we've still got, the low risk, low return ones here on the bottom left, like the world cash. And then going on to, SA cash and SA bonds and world bonds, and moving up towards the higher risk, higher return ones like global equity, SA equity and SA property. But what you can see along the bottom axis is the time horizon. So if you have, at least 5 years to invest, then you're going to do well in world equity. If you have 7 years to invest, then you should be looking at something like a growth asset that gives you some return, albeit with some bumps along the way, something like the SA equity and the SA property. And that is really, that is just really a very high level overview of how you should start to think about the difference between, sort of safe assets, if you want to put it like that, defensive assets, the low risk, low return assets like cash, like money in your bank account, like bonds, versus the growth assets that are going to give you some return, but they're going to be a bit bumpy along the way, like properties and equity. And, the obvious question is, why wouldn't you just want to sit in cash or in bonds or in something safe and be able to sleep at night? This is the reason, is because you're going to get eroded by inflation. So every year, your money sitting in the bank is worth less. So we have to make sure that a portfolio, especially a long-term portfolio that's planning for retirement, needs to have enough growth assets in there to make sure that you're keeping up with inflation. And so this is the last slide on the topic here that I'm going to show you today. So on the left is equity. And the three colors are, the light blue is probability of maintaining purchasing power, so just keeping up with inflation. So if your investment just keeps up with inflation, it means it's not growing. It means in real terms, in terms of what you can buy with that money, it's not increasing, it's just keeping up. So generally with investments, we want our money to grow. So we want to be targeting, you know, inflation plus something. And so that's why the dark blue in the middle is inflation plus 3%. So what are the chances of equity delivering inflation plus 3%? And so just looking at equity, you know, over long periods, you've got a 90% chance of keeping up with inflation, 75% chance, or 76% chance, should I say, of, you know, beating inflation plus 3%, so actually growing your investment. And then the red one, the 65% chance, so actually in equity, you've got a 65% chance over long term of beating inflation plus 5. And that's typically where we want to look when we're looking at sort of, most of our investors want to target something like that when they're looking for a long-term retirement portfolio. On the other hand, if you're going to sit in bonds, this is the risk. So you've only got a 60% chance of keeping up with inflation at all, a 37% chance of beating inflation, so inflation plus 3, and a you know, 30% chance of getting inflation plus 5%. So that is the risk of, if I want to say risk in sitting in a low risk asset, is that you can, your purchasing power can be eroded by inflation. So this is just a very high level overview to make you start thinking about the asset mix decision. And next week when Chris Rule joins us for part 2 of the series, he's going to show you how we at CoreShares combine all these different asset classes to balance both, you know, keeping up with inflation, but also delivering enough return, but keeping your assets, you know, diversified and that sort of things with the investor's goal in mind. And so the last topic that I want to just touch on today, which has to do with, again, what flavor of ice cream, what's in the bowl, what's inside your fund, whether it is an ETF or a unit trust, is the decision between active and passive management. And I'm sure you've heard a lot about this. It's quite a hot topic in the press. So active management is when you have a portfolio manager or a team of portfolio managers and analysts who are doing research and they're trying to pick the winners. So they're looking at, you know, all the companies in South Africa, for example, and they're trying to predict which companies are going to perform better than the overall market. And they charge higher fees. Obviously, you can imagine there's, you know, a whole team of portfolio managers and analysts that need to be paid for their efforts. The risk with this style is that they can sometimes get it wrong. So you're paying them the fee, but they actually don't deliver. That's the risk there. On the other hand, a lot of investors like to use a passive strategy, which just simply tracks an index. So a simple way of thinking of it is, rather than trying to find a needle in a haystack, buy the whole haystack. So instead of trying to pick the outperformers in the market, just buy the whole market. And that's just really a very high level, simple way to think about passive investing. And the reason why it has gotten a lot of credibility, specifically in sort of the academic circles, and it is filtering its way through to more broader sort of financial professionals in the investment industry, is the actual track record of the active managers in consistently outperforming the broader market is not very compelling. So there's a scorecard called SPIVA. It stands for S&P Index versus Active, which in this one, they've got sort of, they look at all the different asset classes, but this particular one is looking at global equity. It's looking at South African managers, you know, offering funds that give you exposure to global equity. And they looked at all the active managers in South Africa with their global equity funds. And in the 5 years to the end of June last year, 91% of them underperformed. So that's taking into account their performance and then less of the fees that they charge. What are you as the investor left with? You're actually left with less than what you would have had if you just simply bought the whole market. On the other hand, 9% did manage to outperform. So some managers can outperform the market. Some managers do have skill in picking outperformers. The problem is only 9% of them managed to do it. So you as the investor have the challenge to try and find which are those 9% managers that are going to outperform the market. And that is really the tricky part about it. And, you know, is this figure consistent? Was that just something special over COVID? Or was this something that we've seen year after year? So we looked, so this is just pulling out the SPIVA numbers. So that same scorecard comparing, you know, how did the active managers fare compared to the broader market? going back again 15 years, every 6 months, looking at that, 5 years. So the other one was to 2004. This one is to 2014. 2014 to June 2021. So more like six odd years, and in 5-year rolling periods to each of these. So if you'd held it for 5 years and then taken a snap point at the end of each of these 6-month periods, you can see that this performance is quite consistent. So between 89% is the lowest and 97% is the highest of the active managers underperformed the broader market. And so for this reason, lots of investors nowadays are preferring to actually just buy the market, buy an index that gives you exposure to the whole market and charges you low fees, because at least you know there's some consistency there. You're going to get a performance that's in line with what the whole market is doing. You're removing the manager risk of trying to pick that 9% or 3% or whatever the case may be of managers that are going to actually deliver you outperformance. So that's where I'm going to leave it today. The next webinar in the series is next Wednesday on the 2nd of February with Chris Rule. He's going to be, digging a bit deeper into the sort of retirement planning aspect and looking at 2 solutions that we have at CoreShares, the CoreShares Stable Income and CoreShares Wealth Accumulation Funds, which combine asset classes in specific ways to give clients specific outcomes. And again, if you would like more information on sort of passive investing, indexation, any of these financial education topics, we've got a huge library on our website. And I know EasyEquities as well has done lots and lots of webinars, which are all recorded on their Easy ETF pages. So with that, I think we can, Bongani, are there any questions coming through?
Yes, yeah, definitely. But before we do take any questions, firstly, thank you so much, Michelle. That was a really brilliant presentation. I think I speak for everyone else. There was much to learn that I thought I knew, but you definitely cleared it out for me. You touched on a few interesting points as well, specifically my taste buds. I think I can speak for everyone else as well. I do like my ice cream in a bowl. Sometimes I do like it on a cone, and maybe sometimes even like it on a stick. But I think that just speaks to diversification and essentially what your preference is about, what you're looking for in terms of your investments. And there is one question that I actually wanted to pose to you first before anything else. And it is about the costs. And, we did speak about how sometimes it gets a bit tricky and everything, but there's a question that is asking, does the TER and the TIC, do they remain consistent year on year, or do they vary each year?
So they do. Let me go back. Sorry. Close your eyes. I'm going to make you dizzy. I'm just going to flick back to that slide. Okay, so they do vary, and that again comes down to the fact that some of these running costs can vary, and that the TIC can vary. I mean, as you can imagine, portfolio rebalances, there can be a big rebalance the one year and a smaller rebalance the next year. I suppose with active managers, there might be more variability around that than through an index product, which has got, consistent rebalances at certain times of the year. So you would expect that those costs would be probably a little bit more consistent from year to year, but it shouldn't vary hugely. I mean, the one thing to note is that when a fund is small and it's growing, when it's going from, let's say, 10 million to 100 million to a billion, the TIC can spike in the early phases of a fund's sort of seeding phase, because as you can imagine, there's a lot of money getting put to work for a fund to grow from 10 million to 100 million to a billion. There'd be a lot of portfolio trading going on and a lot of trading costs going into the fund. That's often why fund managers will give you sort of like special rates to go in early and seed a fund.
Perfect. And I think that kind of leads us into the next question, which you have partly answered. The question reads, do the products inside a unit trust change? And if they do, are investors advised of these changes?
Yeah, so good question. So going back to sort of some of the transparency that we said, so all funds would have to have a mandate, which they say, what is that goal of that fund? So if that fund says it's a fund that invests in South African equity, they're not allowed to suddenly tomorrow go and start buying Tesla and Apple because they read that it sounds interesting, because it's a US share and they have said on the mandate that they only have South African equity in their fund. So the mandate will give you some comfort around what the fund manager is allowed to do. On both unit trusts and ETFs, they have to disclose the holdings regularly. ETFs are daily, unit trusts, I think some of them are quarterly at the minimum. So you will always know after they've done the changes, you will always know what's in the fund. With index products, which track an index, they can only invest in what's in the index. So that is more controlled, if you like. So for example, we've got an ETF called the Core Shares Top 50 ETF. It invests in the 50 largest companies in South Africa. So that is only what you will ever see in there. If the fund rebalances on one of the quarterly rebalances, maybe some of the companies have, become smaller, their market cap is reduced, they'll drop out, and other ones will come in. But it's all very formula driven, and it's according to the index methodology. And by the same token, if an active manager has said what their strategy is, what their mandate is, they do have to act in accordance with that, and that's part of what's regulated.
All right, perfect. And I've got $1 million question here for you. Do ETFs and unit trusts, do they both offer distributions?
So there are different kinds of ETFs, but all of our ETFs do distribute. Our local ETFs distribute quarterly, and our global exposures distribute semi-annually. Some ETFs in the South African market are accumulating ETFs or roll-up funds, so the ETF dividends would be automatically reinvested. Unit trusts generally don't distribute. But again, I think these are all settings that you can explore with your stockbroker. So I know with most stockbrokers, and I'm sure EasyEquities has the same, but you can set if you want your dividends to be paid out or automatically reinvested. But it is something that certainly on ETFs you'd need to check on the individual ETF basis.
Definitely agree with that. And one more question, just to keep on the ETF track. Are all ETFs passively managed? Do you at Core Shares have any actively managed ones?
So currently in South Africa, the definition of ETF that is maintained by JSE only allows for passive ETFs. So yes, in South Africa at the moment, all ETFs are passively managed. However, in international markets, there's huge growth within the active ETF space, and it is something that the JSE is looking to expand the definition. So it is possible that we will have active ETFs in South Africa at some point in the future, but it's not the case yet.
Not the case yet. Okay, no, that's perfect. I think I have a few more questions, but most of them are more or less the same. I have a question here by somebody who's asking, why aren't ETFs offered in the RA facility?
Yeah, that is something that we don't at Core Shares offer an RA. So that's not really something that is that I can comment on. I don't know if you guys from the EasyEquity side have a comment.
So yeah, so we currently at the moment, obviously we still only have bundles and unit trusts in the RA. I think we're still in the process of expanding our offering. So we're definitely kickstarting a campaign, and I hope you guys will, be along with us for this whole ride to try and boost up our retirement funds and just, get more knowledge out there to the people, and just bring more responsible investing, for your own safety and future as well, I guess. So I think that's a safe answer.
I think with anything that pertains to retirement, it's a very heavily regulated space. So sort of changes and new products always take longer to reach that space because there's just so many more hoops to jump through with regard to what's allowed. So yes, I think, as I said, ETFs are a newer product than unit trusts, so they are still sort of growing and finding their way into all these places. So that's good to hear, Bongani, that EasyEquities is in motion already on that one.
Definitely. No, that's perfect. All right. So I think that kind of wraps it up for the day. Once again, Michelle, thank you so much for coming in today and taking the time to present to us, answer these questions so diligently, and giving us the ice cream analogy. I think that one's going to stick with people for quite a long time. Just again, to the people who missed the beginning or have missed the entire webinar, this is being recorded and we will upload this on our YouTube channel. Should be available within the next day or two, but we'll try to push out as soon as possible. Do not forget to join us again next week for our second part of the series with Chris Rule. We will go into a much deeper dive than we've done today. I hope you guys will be there with us.
Thank you so much for having me, Bongani, and thanks to everyone for dialing in.
You're most welcome.
So easy, so easy. So easy, so easy. So easy, so easy.